welcome. You're watching NDTV Profit and you're watching Cracker Stocks with NDTV Profit. A very happy Diwali to everybody who is watching NDTV Profit. This is Mahima Vachrajani and with me is Harsh Saita. Well, Samvat 2080 marked a historic milestone for the Indian equities. The Nifty did reach 26,000 in September. We also saw NSE and BSE post impressive gains of 24% and 26%. Mid-cap and small-cap indices also outperformed, delivering 42% and 40% respectively. But going ahead, what is the strategy that one needs to adopt, and also what are the factors that have led to all of these growth? To discuss all of this, we are joined by Deven Choksey, Managing Director of DRChoksey Investment Managers Private Limited, who joins us now. We also joined by Vijay, Chopra, MD and CEO of Enoch Ventures, he is also joining us, and we're also joined by Amisha, Vohra, Chairperson and Managing Director at PL Capital, that is Prabhudas Leeladhar. All of you, first of all, a very happy Diwali to all of you and welcome to NDTV Profit. I'll start my first question with what I said. The Nifty has had a wonderful run. We did touch 26,000, marking outperformance in, left, right and center. The small caps, mid caps, everything outperformed. Do you think that this outperformance is sustainable since we're entering into Samvat 2081?
Well, I guess wish you all the happy Diwali first and foremost, and I would pray God for the blessed year, I think, in 2081 Samvat. We all have seen, I think, a phenomenal run in the last 2 years in the market. This run has been propelled by a lower base on which higher growth has happened. And at the same time, I think the phenomenally high amount of liquidity which has entered into our markets, which probably, I think, fueled this entire bull run. To me, I think this entire bull run is likely to continue over next 10 years. However, in between, there are going to be the situation wherein probably you are going to see the corrections. And that's where probably I believe that we are getting into some kind of a price correction along with the time correction in the coming 1.5 to 2 years, as I see it. Nothing wrong fundamentally with the economy, nothing wrong with the prospects, nothing wrong with the companies and their workings. However, the market is supposed to get adjusted based on the price and the valuation, which currently remains at the elevated level. If the growth in the corporate earnings sector is not matching with the market valuation, probably the market valuation will have to correct first, because I think growth cannot speed up the way market is expecting. That's what I think the underlying narrative here would be. And one is expected to see the corrected market in 1 or 2 quarters to begin with.
Sure. So opening thoughts, Amisha, let me come to you with regard to how you believe valuations are stacking up. Can earnings catch up with the way valuations have moved?
So I broadly agree with the thesis that we had a earnings bump up, largely also because of the provisioning which went off from the banks. But also beyond that, our inflation trajectory was very stable, and also the interest rate trajectory. As we speak on the ground, we feel that a little bit of urban slowdown is visible across categories. Inflation is slightly inched up. And in that scenario, there are no extraordinary triggers or base correction effect or anything which can really pump up the growth numbers.
Vijay, let me come to you. So, when you're looking at how this theme of earnings is playing out, do you expect that markets will be range bound from this Samvat to the next?
Well, I think, first of all, thank you for having me on the show, and I wish the entire viewers of NDTV Profit a very happy festive season, happy Diwali, and a safe Diwali. Well, yes, we are going through the earnings season, and I'm kind of disappointed the kind of numbers we are seeing. I think I was on your show a few days back, and I mentioned that the disposable incomes have to go up. The inflation, as Amisha said, was quite sticky, and inflation is not leaving much money in the hands of the general public. Secondly, taxation. We are very high on taxes. So, these high taxes are definitely a drain on the balance sheet as well as the, balance sheet of any household. Number three, in spite of the low crude prices, the government is not bringing down the fuel prices. I think that there should be something happening there. Number four, I was expecting that there would be at least 25 bips of rate cut in this credit policy, which did not happen. All these triggers have to come in and join hands together to pump up the economy. Definitely, we are seeing a slowdown. The auto numbers are not very exciting. I've been talking to auto ancillary people. They are also saying that there's a clear-cut slowdown in the auto space, and inventories are pretty high. Yes, the demand for luxury items it's growing leaps and bounds, but at the same time, the entry-level cars, the entry-level bikes, we saw what happened with Bajaj Auto, and they are not seeing a very good festive season either. So the two-wheeler segment, the entry-level car segment, or maybe cars still maybe 12, 13 lakh rupees, it's not going up, and it's a clear, we can derive from this that there is a slowdown. People are not having much disposable incomes in their hands, so it's the spending is not happening. So I would say the government should work on the spending side. Secondly, sort out the supply side issues as well as the agri commodities go and leave more money in the hands of common people. This jugglery which happens in every budget, actually is not leaving much in the hands of people. I was talking to somebody or reading somewhere that the ATC level, the relaxation under Section ATC has been the same in the last 10 years, while the inflation has been inching up 5-6% every year. And the actual inflation is much higher than the numbers which are quoted by the RBI and actually what so I think that catch up with the earnings, we should see spending at the bottom of the pyramid.
Right. Okay. So opening thoughts. Deven, let me come back to you. You've triggered this conversation where likely markets will be either range bound, they're not going to go anywhere much, because nothing wrong with the numbers per se, but just with regard to how valuations have run up. Now, if I were to just try and deviate from this argument and go more towards flows, FIs have been withdrawing money. It's a interest rate cycle which is anticipating sharper rate cuts going forward. In such a cycle, shouldn't markets actually be more buoyant?
Well, I think there is a logic behind it. On one side, we are talking, guys, we are not talking about the traders within FIIs. Tell me one thing, which FI investor has withdrawn money from the market? People don't sell their stocks and they withdraw money out of this market. I think only the traders, they're swing their money from one market to the market. And that's what is causing the upsides and the downsides in the market. I don't think that it's permanent. Maybe I think they are waiting for the valuations to come down to bring money back into the country, which they will do, pretty sure. On the other side, the domestic funds are attracting significantly large amount of inflows of money. 24,000 crore worth of SIP has already been established. And I believe that the allocation of money towards financial assets, they continue, be it AMC, be it insurance fund, be it pension. I think the money continues, except fixed deposit. The money flows into the different areas of financial instruments. So in my viewpoint, domestic liquidity will continue to support the market. And that's why I'm not expecting sharp price correction. I'm expecting time correction as far as the market, the valuation of these stocks are concerned.
All right, Deven. I also want to understand that the small caps and the mid caps have seen a significant up move. Now they're trading at very high valuations or premium valuations. So going forward, what should be the approach towards the small and mid caps? Especially in pockets which are high growth sectors like the AI or the EMS or the EV sectors, that are really growing well. So Amisha, I'll come to you with this one. Your view on the small and mid caps, especially in the high growth pockets.
So what's been really happening in the market is that the distinction between a very capable management, an upcoming management, or a mid-sized company's management, or an average management has completely gone away. So the growth is an outcome of opportunity plus management capability to tape that growth.
Amisha, but in your opinion, what are the top 3 sectors that you think will, augur growth in Samvat 2081?
There are two outlooks to it. One is in terms of absolute growth. I still feel that on PAT basis, the capital goods segment will continue to throw YY very good numbers, be it coming from railway stocks or defense stocks or actual other stocks like Praj and so many more. Of course, Siemens, ABB, transformer companies, wire and cable companies, the growth will continue to be really very good in that. While I feel that the growth, actual PAT growth, in some of the other sectors cannot match there, be it defensives like IT or pharma or consumer. But markets don't look at just the absolute growth. They look at growth as compared to the expectation as well as previous growth and at what price the growth is available and how is the ownership of that growth. Good amount of portfolio should continue to remain in pharma, IT, consumer, AMC, and large and mid cap as compared to small and micro cap.
Right. Vijay, seems like we have a consensus here with regard to the fact that markets will be range bound. How should you outperform? Where is that pocket of opportunity according to you?
Well, I concur with Amisha ma'am when she says that there are pockets of excellence. There are certain sectors which are going to grow. I think that metals give a great opportunity. With China coming down and they're giving a lot of stimulus in their economy. So I think that it would propel global metal prices. And one of the stocks I'm going to mention today is also from the metal space. We are in a long-term bull run as far as the metals go, especially the industrial metals. We have seen what has happened with silver and copper. So I think that metals are a great sector to be in and kind of safe also. The second sector I like is IT. I think that IT has been an underperformer in the last few years, but the next couple of years seemingly are very good and very exciting. AI is doing wonders. Most of the IT companies, they have done away with the bench strength and the extra flab which they had on their as on the rolls. So they are much smarter and much leaner as a company because most of the IT companies, the greatest amount of outflow is in salaries. So they have done quite a good job there. I think defense is also one area where I would focus. The reason is there are a few wars going on. People are and countries are worried about their security, and the government of India also wants to focus or is also already focusing on a lot of defense companies. We are great in shipbuilding. The kind of orders we have received in shipbuilding, they are actually stupendous. And the companies like HAL and all, they are getting huge amount of orders from smaller countries. So I think that defense is one area which I would look at. IT and of course the luxury segment. As I mentioned earlier, there is a dearth of if you go and to buy a luxury watch, they will tell you that you can get it maybe 6 months down the line. Similarly with luxury condos and apartments and stuff like that. So I think that the richer are getting richer, the rich are getting richer, and there is a lot of money to be spent and to be splurged. So one of the stocks I'll mention today is also from that sector.
Oh, okay, Deven, let me come to you. You've said that dips are going to be smaller, and therefore it's again going to be range bound, but dips are going to be smaller. So how much do you expect in terms of a dip or a correction? And if that were to happen, what would you be going out and buying?
Well, I think that can be a guesswork as well. But I believe that I think the across the market correction is possibly ruled out at this point of time. You might see in pockets, I think some corrections emerging and emerging stronger. For example, I think recently you saw, I think the sharper degree of fall in likes of Reliance, HDFC Bank, market corrected. But whether I think across the board everything has corrected that sharply, Maybe answer is not. Maybe in some cases it is not. In my viewpoint, I think today, as I am making a point, if you are on a richer valuation and if you do not have the commensurate growth catching up with it, then possibility of individual stock correction is much higher as against I think the entire market corrections happening in the Indian markets. So I think one will have to be very, very careful about how exactly one looks at individual companies and what the dynamics are on those companies. I would tend to believe that those companies which have created significantly large base and they have the ability to probably perform and deliver on the growth, they would be comparatively better off compared to the smaller ones, I think, who are probably not having the sustainability factor built into them.
Deven bhai, I want to understand that, you expect markets to remain range bound, but do you expect earnings momentum to continue? And if yes, how will you play it then? What will be your top picks then?
So I have kept a very simple formula in front of me. When your economy is growing at around 7.5%, add to it inflation, nominal rate of growth around 12%. On the 12% nominal growth in the economy, if you end up getting 18% kind of a growth on an average for next 2 years in respective business, respective companies, I would consider that as a good growth which this company will manage. So from that perspective, I think would be very comfortable. As far as individual stocks are concerned, I think we have kept our focus on accumulating some of the companies which I think may give an opportunity during the corrected phase. The likes of Tata Technology, the likes of Bajaj Housing Finance, or for that matter, likes of Geo Finance. I think we believe that these companies have got inherent strength. The fundamentals are definitely, I think, in place. And we could possibly see, I think, the surge in earning after a couple of years in these companies because of the business plan that they are executing. So certainly we remain more positive on that front.
Amisha, India has now surpassed China when it comes to the MSCI Emerging Market Index. So I want to understand that going forward, how do you see India's global positioning for the next 12 months?
So I think that we continue to remain, compared to most other large economies, one of the most robust economy, both in terms of government balance sheet, bank balance sheet, corporate balance sheet, and individual balance sheet, which reflects into the virtuous cycle of growth that we all are into. And because of that, as you see, the internal financialization of savings is also continuously picking up. So it's a matter of time when I think that at a slight correction also, the flows which have gone out from India in the second half of this summer probably would start re-looking at India with a lot of vengeance. In the meantime, I would still take a call of continuing with quality stocks. And within that, I did maintain certain sectors where the focus should continue to remain.
Fair point. Vijay, let me come to you. We've seen a year where everything's gone up. You've seen gold giving a 30% return. You've seen real estate do very, very well. You've seen the stock market, of course, extremely buoyant. You've also seen tight liquidity, and you're seeing even bond yields temper off a little bit, maybe at least over the last quarter or so. They've gone down by around 25 bips. So some gains in bonds as well. This is unprecedented. What explains it?
Well, yes, we've had a kind of dream run in practically every asset class. And this is at times too good to be true. I think that markets, if they are correcting or they are consolidating, I would be really happy because, this unusual valuations, stretched valuations are not sustainable. And I think that, there would be pockets of excellence, as I said earlier. And the research work would definitely go up, and making money in the markets won't be that easy in the next couple of years. Now, the companies have to show a good balance sheet. They have to show a lot of fiscal discipline, so to say. And yes, the men would be separated from the boys. But yes, for sure, as I said, I think that the government should plan to leave more money as in the hands of people as disposable income so that they can spend.
Okay, absolutely. Deven bhai, let me come to you. Are you also of this view that policy needs to get better this year, tax or otherwise?
Yeah, I think the governments have the habit of playing around with the tax rates, and I think they continue to do so. So we have to neglect that part of it to a certain extent.
Right.
Not that I think we would give up on that. I think we definitely represent our views, but I think they have the habit. For example, in capital market segment, I think they charge instance of tax, I think 5 different places. It's unwarranted, but I think somebody should go and tell them that I think this is not required. Now, having said that, I think whether they want to listen, that's a good question to ask. But nonetheless, I believe that I think this argument can not stop. I think it can keep on going. As far as we are concerned, I think our job should be to keep looking at the opportunities in the market, keep producing return for investors, and sustain this entire momentum over a longer period of time so that you can get compounded rate of return in your portfolios.
All right, we've already taken top picks from Deven bhai already. Amisha, your top picks Diwali, or let me put it this way, your cracker stocks for Diwali this time, and why, of course.
So I think I would go by these 5 names. I like Divi's. I, meaning we as a house PL, like Divi's, Trent, Praj Engineering, HDFC AMC, and Tech Mahindra. And I'll tell you one liner for each. Divi's in last 2.5 years, post the COVID peak, had their earnings slashed down, profits by almost 50%. So there's going to be a huge base effect. Business is robust and growing. When it comes to Trent, they have been doing really well in all their formats, and their new launches are also very, very attractive. So from consumer opportunity size and their ability to penetrate, they are extremely well placed. Praj has its own significant technology advantage, and in the growing market of renewable fuels, they are having 65% market share in the engineering plants. And with their new strategy, I think they will continue to grow extremely well, both domestically and in exports. Tech Mahindra is one technology play which we think should be in the portfolio as the gears change in the IT side of the business. And HDFC AMC, because their robustness in their performance of the schemes, translating into the inflows, net, and in turn, completely net profit conversion into free cash flow is phenomenal. And in these markets, I think such stories can do really well.
Vijay, your cracker stocks for this Diwali and why?
I would name 3 companies, starting with Hindustan Zinc. So Hindustan Zinc primarily is a flagship, one of the flagship companies of the Anil Agarwal Group, Vedanta Group. They still hold about 64%. And the government of India holds about 30%. So the public float is lower than 3%. So I think that is a huge opportunity, as there is a low public float. The company is extremely profitable, still trades at a price to earning of 24, with an MCAP of upwards of 2 lakh crores, a debt of only 14,000 crores. The other company I would like to recommend here is Hindustan Aeronautics. Again, a great company lately. And they've been working and doing a lot of R&D on the new product lines. So Tejas has been a fantastic product for that matter. It's a single jet engine, used in Air Force and Navy. They've received orders from various countries, the smaller countries who cannot afford the Rafales of the world. They cannot go to US, France, and other countries. They definitely turn their eyes towards India and see that what they can buy good airplanes at a cheaper price. So they also have HAL Dhruv, which is a helicopter used primarily right now in Indian Army, and HAL Rudra, which is a light helicopter. There are not many lightweight helicopters available now as options. So they have these few good products in their pipeline, and I think that the stock can do very well in the coming 1 year. And finally, as I said earlier, that the rich are getting richer. So DLF is my pick in the real estate space, and I think that they've done again a phenomenal job with launching a very super great ultra luxury project. So one of the projects they're launching is the Dahlias, which is nearby Camellias, which was one of the most expensive projects they've launched till date, and it is much higher, 25 times more in value than Camellias. So they're going to garner a sales value of close to 35,000 crores. So these three stocks I like as Diwali cracker companies, cracker stocks.
Okay, we've kind of put it all together in terms of stocks which are cracker stocks, but Deven bhai, crackers can also cause their fair share of injuries. So which stocks should you avoid?
Well, I think the list would probably go endless, but the
Sure.
fact remains that I think you will probably keep a close eye on, I think, those companies which are exuberantly valued. And there are plenty of them, unfortunately, in the market. Those who cannot probably meet the growth and probably their value reach, they are the ones who are likely to disappoint the market big time. Also, one of the point why it would be, because I think the market is going to be into the rotations. We are having plenty of new IPOs coming into the market. So certainly an investor would like to offload part of his existing investment portfolios, put money into IPOs. That process is also going to continue on the side. So reach valued companies certainly are be prepared for disappointment going forward.
Okay, so stay cautious, but at the same time, there's plenty of opportunity. That's how I conclude it. But thank you so much, all three of you, for joining us today and for giving us, your perspective with regard to how you believe markets are going to go, as well as what stocks to look for in this otherwise range-bound expected market. Thank you so much, and thanks viewers for tuning in. From Mahima, myself, everyone who puts the show together, thanks so much for watching. We hope you found this one productive, and wishing you and yours a very happy Diwali from all of us here.